Noir Plasma Chrome Bleed. Unlocking knowledge, inspiring innovation, empowering curious minds.
This website makes learning so easy. I found all my resources here.
Like what you share.
Welcome to another Explainer. I am so glad you're here. Today, we're diving into the fascinating world of the Indian indirect tax system. Now, I know what you might be thinking. Taxes? Really? But stick with me here, because we're going to look at this not just as a dry set of statutory rules, but as the evolving, highly dynamic operating system for one of the most massive economies on the planet. When you understand this architecture, you really understand the engine of modern commerce. Okay, let's look at our agenda for today. We're going to cover the evolution of indirect taxation, the unified GST architecture, customs and valuation mechanics, real-world corporate puzzles, and finally, the future of tax reform. Let's jump right in.
Section 1. Evolution of Indirect Taxation.
Okay, so what's really interesting here is this one golden rule underpinning everything we're about to explore today. The destination-based consumption principle. It's exactly what it sounds like. It dictates that tax revenue doesn't go to where a product is made, but to where it's ultimately consumed. Why does this matter to us? Well, because this core principle literally wipes out that systemic cascading effect of taxation, where you are basically paying tax on top of tax all the way down the supply chain. Plus, it keeps trade completely free of distortions.
But getting to that golden rule, it wasn't an overnight thing. It was this epic, multi-decade statutory journey. We're talking starting way back in 1994 with the Bagchi Report laying the groundwork for that, then moving through the Dasgupta Committee in 2000 and the Kelkar Task Force in 2004, which boldly pushed for a national GST. All of this finally culminated in the monumental 101th Constitutional Amendment and the historic GST rollout on July 1, 2017.
Section 2. The Unified GST Architecture.
It's wild to look at the night and day contrast between the old and the new setups. Pre-GST was just a completely tangled web. You had multiple taxable events happening all over the place. Central excise for manufacturing, state VAT for selling, service tax for providing services, and all of them had these restricted, fragmented credits. You couldn't easily offset one against the other. Post-GST, thanks to Articles 246A and 269A, we get a beautifully unified architecture, a single taxable event known simply as supply. It features a totally seamless flow of input tax credit across the entire value chain and a unified dispute resolution system. So much cleaner.
Section 3. Customs and Valuation Mechanics.
But what happens when goods cross international borders? While domestic tax is unified under GST, the Customs Act remains its very own beast. When you import, you face this mathematical cascade under Section 14 just to find your assessable value. First, you have to convert your foreign free on-board value into rupees, strictly using the CBIC notified rate. Then, you add your freight and insurance to get your assessable value. From there, you apply basic customs duty, then the social welfare surcharge, and finally, integrated GST or IGST. The really brilliant part here is that the IGST you pay at the border actually qualifies as eligible input tax credit domestically, which completely prevents duty cascading across your international supply chains.
Section 4. Real-world corporate puzzles. All right, enough theory. Let's stress test this architecture with some real-world scenarios straight from high-stakes CA final examinations. Let's start with Apex Manufacturing. They bought a motor vehicles strictly to transport raw materials inside their factory, and they also purchased employee health insurance because the Factories Act legally mandated it. Now, normally, passenger vehicles and health insurance are completely blocked from input tax credit under Section 17.5. So, do they get the credit here? Take a guess. Actually, yes, they do, because the vehicle is used exclusively for goods and the insurance is a statutory mandate. Both of these bypass the normal credit blocks entirely.
And when Apex goes to actually use those credits against their tax liabilities, they absolutely have to follow Rule 80A. You can't just use credits however you want. It's a very strict sequence. You must exhaust your IGST credit entirely against your IGST output liability first. Any leftover IGST liability is then covered by CGST credit. Only after that is totally sorted out can use your remaining CGST and SGST credits to pay down their respective liabilities, with any final balance paid in cash. It is quite literally a sequential mathematical puzzle.
Moving right along to Scenario 2, we've got Veloci Tech. Based in Karnataka, they provide cloud hosting to a client in Singapore, on-site tech support to a company in Gujarat, and they themselves receive event sponsorship from a firm in New Delhi. How do digital borders impact taxation here? Well, place of supply and time of supply rules dictate absolutely everything.
Let's break this down. The Singapore cloud hosting qualifies as an export of services, so it's zero-rated. Easy. The tech support in Gujarat is a straightforward interstate outward supply, so Veloci charges IGST. But the sponsorship is where it gets super tricky. For corporate sponsorships, the reverse charge mechanism, or RCM, kicks in. This shifts the tax liability completely. Even though Veloci Tech is the recipient of the sponsorship, they are the ones legally obligated to pay the IGST directly to the government, not the supplier.
Next up is Scenario 3. Greenfield Logistics hauls agricultural produce, government postal goods, and household shifting items. They use the exact same trucks for all of it, sharing diesel and repair costs. Now here is the massive headache. Agricultural transport is exempt from GST, but household and postal goods are fully taxable. So out of all that truck repair GST, how much can they actually claim as credit?
Well, first things first, diesel is outside of GST entirely, so that state VAT is just a sunk cost. No credit for that. The truck repair GST is an eligible common credit, but because they do both exempt and taxable hauling, Section 17(2) and Rule 42 step in. The math here perfectly proportions the credit based on the ratio of exempt turnover to total turnover. You just take the total common credit, multiply by the exempt turnover, divide by total turnover, and you must reverse that exact amount. You literally only get to keep the credit that is strictly proportionate to your taxable business.
Scenario 4 takes us straight to the docks. Quantum Imports buys a €100,000 machine from Germany. They pay design fees to a consultant, and unfortunately they incurred demurrage charges for delayed clearance at the Mumbai port. Now, the RBI exchange rate is 89.50 rupees per euro, but the CBIC rate is 88 rupees. What actually goes into the final customs assessable value? Which exchange rate do we use? And do those annoying delay penalties count?
Let's see how this actually builds. By law, you must strictly use the CBIC rate of 88 rupees, totally ignoring the RBI or commercial rates. You absolutely must add the €8,000 design fees because they were necessary for production. But the demurrage charges, because they happen to post-importation, they are completely excluded from the assessable value. Once you lock in that value, you cascade your basic customs duty, social welfare surcharge, and IGST right on top of it.
And our final stress test, Scenario 5. Farsights is having a really rough month. They lose 200,000 rupees worth of TVs in transit, just completely destroyed. They hire unregistered transport, they pay a prime location lease fee to the housing board, and to top it all off, they file their tax return 9 days late. What does all this mean for their final liability? Honestly, the system is completely unforgiving here. Under Section 17(5)(h), because those TVs were destroyed, the input tax credit is explicitly blocked. It's just lost money. The unregistered transport and those prime location fees, those trigger the reverse charge mechanism, making Farsights fully liable for the tax. And, because they filed late, Section 50 hits them with a strict 18% per annum interest on their net cash tax liability. The absolute most critical takeaway here? Both RCM liabilities and statutory interest must be paid strictly from the electronic cash ledger. You absolutely cannot use your accumulated input tax credit balances to pay them off.
Section 5. The future of tax reform.
So, we've navigated the micro-level corporate math, but where is this global and digital tax operating system actually going next? Well, the future is completely technology-driven and real-time. We are moving away from historical compliance and right into instantaneous enforcement via automated tech flows. Today, when you generate an e-invoice, it automatically populates your outward supply returns and generates shipping waybills. Instantly, this data flows into the buyer's return, creating a system-reconciled, closed-loop electronic ecosystem. It practically eliminates manual fraud and ghost invoices across interstate supply chains overnight.
On the policy horizon, regulators are actively patching the system's bugs. The operationalization of the specialized GST appellate tribunal is going to unclog the high courts, providing uniform judicial resolutions for complex disputes. Furthermore, they're looking to collapse the multi-tier tax slabs into a rationalized three-tier framework. This aims to fix inverted duty structures, which is a huge flaw, where the tax on your raw materials is actually higher than the tax on your final product. Right now, that traps massive amounts of corporate working capital and endless refund loops, and it definitely needs fixing.
But the most profound shift is happening globally. Doctoral research by scholars like Lemensch and Mbile highlights a massive paradigm shift. Conventional tax rules always required a physical nexus, like a brick-and-mortar building in a country. But in the digital age, physical presence rules fail completely for intangible deliverables. We are seeing a huge transition where unilateral digital taxes will eventually align with global minimum tax standards under OECD Pillars 1 and 2. This is going to prevent double taxation for multinational digital enterprises all over the world.
So the architecture of indirect taxation has evolved from messy, fragmented state levies to a powerful, unified national system, and now it's rapidly integrating into a global digital framework. The rules of the game are changing faster than ever, so I'll leave you with this. As digital borders completely vanish, as compliance becomes instantly automated, and global minimum taxes take full effect, is your tax strategy actually ready for the future? Thank you so much for joining me on this explainer. Keep learning, stay curious, and I'll catch you next time.
Like what you share.
This website makes learning so easy. I found all my resources here.
Noir Plasma Chrome Bleed. Unlocking knowledge, inspiring innovation, empowering curious minds.